Hello again. Today, we're going to be talking about an option strategy called the credit vertical spread. Now, this is an option strategy that I use very often. It's basically my bread and butter strategy. And why do I use it? Because it offers me so many benefits. First of all, this is a net option selling strategy. So actually, we're getting all the benefits of selling options that I talk about in this video, such as, putting probability in your favor, putting time decay in your favor, and putting volatility contraction in your favor. Using this strategy also allows us to limit our risk. I'll talk more about this as we go along. The relative returns on each trade is also much higher. I can potentially make about 20 to 50% return on my capital on each trade. We can execute this strategy on small trading accounts. Ultimately, this strategy is pretty easy to implement, so it's very friendly for beginners as well. For the purpose of this video, I'm just going to be talking about the mechanics of how this particular strategy works. By the end of this video, you should know what are the two types of credit vertical spreads and what are the risk and reward payoffs for implementing them. In the interest of time, I'm just going to assume that everybody here already has a functional understanding of what are options. But if you're really new to options trading, do check out this video first so that you get an overview of what are options and what is options trading. A credit vertical spread is a position that is made up of two options trade. We will sell an out of the money option, and then we will buy another option that is even further out of the money for protection. Whether we use call options or put options depends on the direction in which we are expecting the stock price to move. I'm going to skip out on all the technical jargon and just use two examples to demonstrate exactly how this works. These are real examples in the market, but I'm not going to specify which stocks these are because this video is just meant to illustrate how the strategy works and not meant to provide specific investment advice about any particular stock. This is an example of an uptrending stock. And let's say I think that this support line is really strong and the price is quite likely going to remain above $300. I want to execute a position that gives me the benefits of selling options, but I also want some protection in case I am really wrong. Let's say there's someone out there called Mark, and Mark owns shares in this particular company. So Mark maybe is looking at the chart just like me. Mark has also identified this 300 support line, and maybe Mark is afraid that the stock might drop significantly below 300. So what can Mark do to protect his position? He might buy some insurance in the form of a put option with a strike price of $300. If the share price drops significantly below 300, he can sell it for $300 and minimize his losses. So if I think that this stock price is not going to fall below 300, it's going to stay above $300, I can actually be the insurance seller. I will sell Mark the put option, let's say $300 strike price, 2 months to expiration, and I will collect a premium from Mark. So in the next 2 months, if the share price falls significantly below 300, I will have to buy it from Mark at $300. But if I'm correct and the share price stays above $300, then I don't have to do anything. Either way, the premium that Mark pays to buy the insurance is mine to keep. But what happens if I'm really wrong and the share price falls really significantly below 300? So I may also want to buy some insurance for the put option that I've sold to Mark. So I can buy a put option with a strike price of $295, which is a lower strike price and further out of the money from the option that I sold to Mark. So if I'm really wrong and the share price significantly falls below 300, I'm obligated to buy it from Mark at $300. But I have the rights to sell it away at $295, and this will minimize my losses. So this credit vertical position is known as a bull put spread. So it's made up of two option positions. I will sell a put option that is out of the money, and for protection I will buy a put option that is even further out of the money, both of them with the same expiration date. Now let's see how this strategy can play out from a financial perspective. So I sell the 300 put option to Mark and I receive a premium of $770. I buy the 295 put option and I pay a premium of $645. So the net amount that I collect from this trade is $123. This $123, I will collect it, I'll receive it regardless of how the trade plays out. As long as the stock price remains above $300, both of these options are going to expire worthless. Their value will go to zero. So my maximum gain on this trade is the amount I receive, which is $123. Now let's say I'm wrong and the share price falls below $295. So because I sold the put option, I am obligated to buy his shares for $300, and that would be a capital outlay of $30,000. However, I can exercise the put option that I bought and I can sell away these shares for $295. So for selling away the shares, I'll receive $29,500. In this scenario, my losses will be $500. However, because I received that premium of $123, this actually makes my maximum loss on this trade $377. So over here, we see the payoff diagram for this particular trade. So my maximum loss on this trade is $377, regardless of how low the share price can fall. Even if the share price falls to zero, my maximum loss is still $377. But at the same time, if I'm correct, the share price stays above 300. No matter how high the share price can go, my maximum gain is capped at $123. So we can say that the capital that I risk on this trade is my maximum loss of $377, and the potential gain is the maximum I can make, which is $123. The expected return on my capital would be 33%. Statistically, I have a 70% chance of being correct on this trade. So all in all, with this trade, I have a 70% chance of making a 33% return over 2 months. Sounds great. Now, what if we are expecting share prices to fall instead? Can we still use this strategy? In the second example, we're going to be looking at a downtrending stock. Now, let's say I've identified $190 as a very strong resistance line, and I expect the share price to stay below $190 for the next 2 months. I would execute the exact same strategy, implementing the same principles, except this time we are going to be using call options in a strategy that is known as the bear call spread. I'll be selling an out of the money call option with a strike price of $190, 2 months to expiration, and for this I'll collect a premium of $620. For protection, I'll be buying a further out of the money call option with a strike price of $195, also 2 months to expiration. For this call option, I will pay a premium of $470. So my net proceeds from these two option positions is $148. And just like the previous example, this $148 proceeds that I receive is my money to keep regardless of how the trade plays out. As long as the stock price remains below $190 over the next 2 months, both options will expire worthless and their value will fall to zero. So the maximum I can make on this trade is the net premium I receive of $148. However, if I'm wrong, and let's say the share prices go above $200 and beyond, I am obligated to sell the shares for $190. So I will receive proceeds from that sale of about $19,000. If I don't have shares to sell, I'm going to have to go into the market and buy it at the current price, which right now is way above the strike price of $190. But in this example, thankfully I have the protection that I bought. So the call option that I bought enables me to buy shares for $195. So that will be a payout of $19,500. So once again, my loss on this transaction is $500, but because I received the premium of $148, that makes the total maximum loss on this transaction $352. This is my maximum loss regardless of how high the share price goes. Likewise, $148 is my maximum gain regardless of how low the share price falls. So all in all, this gives me an expected return of 42% on this trade. And once again, I have a 70% statistical probability of being correct. So this gives me a 70% chance of making a 42% return on my capital for this particular trade. There we have it. These are the basics of credit vertical spreads. What we have gone through today, the two kinds of credit vertical spreads. We will use a bull put spread when we're expecting the share price to remain above a certain level, and we will use a bear call spread when we're expecting the share price to remain below a certain level. And this strategy is made up of two options. We will sell an out of the money option, and then we will buy another option that is further out of the money for protection. And what we are aiming for is that both options are going to remain out of the money and they will both expire worthless. So this gives us all the benefits of selling options because we can put probability, time decay, and volatility contraction all in our favor. In addition, we have the benefit of limiting our risk on each of these trades. And because we can determine exactly how much we're going to gain and exactly how much we're going to risk, these positions can be executed easily by beginners, even on small account sizes. As mentioned before, this video is only meant to cover the basic mechanics of this trade. In upcoming videos, we're going to be giving you more information. We're going to be talking about more things such as how do I select the strike prices for these options? What is the optimal amount of premiums that I should be collecting on these trades? And also, how do I manage the trades if the prices move against me? So we know in credit vertical spreads that our maximum loss is already capped. It's already limited to a certain amount. But some of these trade management techniques can even help us to avoid taking that maximum loss. You don't want to miss out on that information, so make sure you are subscribed. Alright, so that's it for today's video. Like, comment, subscribe if you found this content to be helpful, and I will see you again in the next video.